Hello, ladies and gentlemen. My name is Luke Sarods, and I'm the market analyst at Pepperstone who will be carrying out this webinar today. Coming straight out of London, originally from South Africa, if you couldn't tell from my accent. And just now that we've got the introduction out the way, just a few housekeeping rules before we get started, a risk warning, and then we'll dive straight into the nitty-gritty of this presentation. So here is the risk warning. Just got to show you guys what's happening here. The information provided in this presentation reflects the view of the analyst and does not reflect the opinion of Pepperstone. Is generic in nature and for educational purposes only. With that out the way, let's begin. So to become a good trader, you obviously have to have good information sources, and you need to bring that into your trading experience in order to make better and more optimal decisions while you're trading. So first and foremost, Twitter, I can't emphasize the importance of this app for free financial market news. I'll send a list of some of the best accounts to follow after this email and a follow-up email after this webinar. You can curate lists, you can set notifications. So if I'm out and I'm not by my laptop screen, I can get pinged like a WhatsApp kind of style notification. It comes through and it notifies me of anything major that's happening in financial markets. So the next one I wanted to put on your radar is Zero Hedge. I don't know if some of you have heard of that. It's a financial blog / website presenting staff written articles and aggregating news and opinions from external sources on everything from geopolitics, energy, crypto, FX, equities, etc. A really good website, well-rounded and very informative, and a great learning tool too. Then obviously you've got Pepperstone's own internal market analysis section on our website and our Telegram channel, which we'll provide a link to for you to join, where you'll get notified of when we release new research, as well as any interesting groundbreaking market news that's happened. We'll give a very brief short analysis with a chart. I do a weekly closeout analysis every Friday afternoon around UK time. And that just covers basically the dollar, pound dollar, euro, US dollar, US dollar JPY, gold, oil, and Bitcoin. And then my head of research, Chris Weston, does a daily fix, which you can sign up for. The others to keep note of are Reuters, Bloomberg, and Financial Times. They're other fantastic sources for you to use while you're on your trading journey. Really good journalistic views. And then if you like more media content instead of reading it, you've got Bloomberg Markets and Finance YouTube channel, which you can check out. We've also got a YouTube channel, Pepperstone's YouTube channel, where you can re-watch this webinar again afterwards if you'd like to. And then obviously to be a good trader, you need to know when massive events are happening. And there's an economic calendar for key events under the toolbox section, MetaTrader. You just click on the calendar tab and then you can filter the specific country or the currency and level of priority that you're wanting to trade. So moving on to the next topic on the agenda, we've got position sizing. Now, this is a very key part of your trading because it keeps you in the game. So the first method we're going to discuss is a fixed dollar amount. So this is the simplest method. You just pick the amount you're willing to risk. So let's say it's $1,000, £1,000, or €1,000. You then take the difference between your entry level and where you would exit the trade if it moved against you. So that would essentially be your stop loss, and that gives you the risk in pips if we're talking about Forex now. Then you need to multiply this by the pip value, which will obviously depend on the lot size, as the profit loss per pip will be different for various lot sizes. So it'll be 10 cents, 10 cents on the dollar per pip for a micro lot, which is 0.01 of a standard lot, and there'll be $1 per pip for 0.1 lot size and $10 per pip for a standard lot size. So from there, you would take your $1,000, the dollar amount that you're willing to risk on the trade, and you would divide it then by the pip risk times by the pip value. So this will give you a number of lots that you need to trade. And it's important to remember, this is key, that whatever lot size you used in that pip value part of the calculation, this will be what the final position size is expressed in. So for example, if you used a micro lot of 0.01 lot, standard lot, in the pip value part of the calculation, and the final answer is 6, then it is 6 micro lots, i.e. 0.06, which you would calculate taking 0.01 times by 6. So with that out the way, the first method, let's move on to the next one. This is the one that most people are familiar with. It's called the fixed percentage risk method. So it's similar to the fixed dollar amount method, but hereby in this method, you decide you don't want to risk any more than 2% of your risk capital per trade. And most traders recommend only risking 2% or less. You might be wondering, why is Luke saying 2%? Well, you know, to stay in this game, there's a non-linear relationship between losses and the required subsequent gain needed to recover from the loss. So if you risk 10% on a trade and you blow out and you lose that, you know, it becomes a lot harder to make gains because you're working off a smaller account balance now, and you actually end up having to take on more risks to just get your head back above water. So yeah, so let's say, for an example, you take your account balance, it could be $10,000, you have multiplied by 2%, which would give you $200. And then you would just follow the steps like you did with the fixed dollar amount method on the previous slide. You'd calculate the risk in pips, which is the difference between the entry and your exit price, multiplied by your pip value. You take that amount and divide it into $200 to get your position size. Again, the number that you would get would be what you used in your pip value segment of the calculation. Now, the next method to use, the Kelly criterion, I don't know if many of you have heard of that. You might not have done. I'm going to walk you through it now. So the formula is basically you take the win percentage probability minus into open brackets 1 minus the win percentage probability divided by the win to loss ratio, which is signified by the capital letter R. So the win percentage probability is just the total number of winning trades divided by your total number of trades. And then the win to loss ratio is the total amount gained by winning trades divided by the total amount lost by losing trades. So these are actual dollar amounts or euro or pound amounts, whatever currency you're trading in. To use this method, you need to take your last, I would say, 50 to 60 trades to get enough data to calculate the above variables. I'd refresh this process every 50 to 60 trades to ensure you're not using stale, out-of-date data. And this is why documenting your trades is so important, as you can refine your system and be more data-driven. Some caveats need to be mentioned though with this method. Given that it's based on your past trades, it's making obviously an implicit assumption that your trading performance now in the present will remain similar, if not the same, to your earlier trades. And then lastly, sometimes the Kelly criterion can spit out large numbers like 20%, and that's obviously clearly too much of your capital to be risky on one trade. So for this reason, many traders will implement a fractional Kelly, so half of that percentage, a quarter, an eighth, a tenth, etc., to bring the position size back to suitable risk levels. And once you have that percentage, you can then calculate your position size similar to how we did in the previous methods, you know, calculating the risk in pips, the pip value, and dividing it by the percentage of your capital that the Kelly criterion has given you there. So that's position sizing out the way. Oh, sorry, this is some general comments about position sizing to finish off with. So suitable position sizing helps control risk and maximize returns. You know, too big and we risk blowing up our account, and too small and we could be limiting our profit potential. So it's all about finding that sweet spot that maximizes our profit while protecting our capital simultaneously. And you can mess around with that and experiment on our demo platform that we provide before you start using real money. You know, you could, instead of taking one large position, you could split into multiple units and you can trim or enlarge depending on the market conditions. And this provides you with more flexibility. So for example, instead of using one standard lot, you could break it up into 10 mini lots. And you could, once it reaches a partial profit target, maybe not your end profit target, but you're not that certain on the trade, you could maybe trim it by 5 mini lots. And therefore, it still allows you to keep a position open in the market to reach that final profit target without having to, if you only had one standard lot, you'd have to close the position in its totality. Stop loss placements obviously important. You can risk the same amount per trade by either having a wider stop with a smaller position size or a tighter stop with a larger position size. I'd try to avoid making your stops too tight, as you could be prematurely closed out of a position on some volatility and noise before the trade has actually had a chance to make a proper sustained move. And another thing to be wary of is stop loss hunting. So if you put your stops just below or above key resistance support, you could see yourself close out of the position before it moves in your desired direction. Institutional investors will try and hunt stop losses of retail traders just below these obvious positions. And what they do is they push the price down lower and get in at a better price, or push the price up higher above resistance to give them a better opportunity, a higher price to short at. So that's something that I think retail traders should really be aware of. There's obviously different ways that you can place your stop loss. You could do a time stop loss. So if the position just remains stagnant and range bound, it doesn't move after a certain amount of time, it could be a week, 2 weeks, maybe a day, 2-3 days, whatever your time period. You could do a support and resistance stop, as I spoke above in the stop loss hunting part. You could do a percentage stop. You could do an indicator stop, where if the moving average crosses below a certain moving average, that would be a signal for you to potentially look at exiting the trade. You could do a previous 2-day candle low if it takes out that, or previous 2-day candle high, depending on if you're long or short. That could be used as a sort of manual trailing stop loss. You can use a percentage of the average true range, which measures volatility, to put your stop loss in. So it's more like dynamic. You're not just saying, I'm going to do 3% or 2% stop loss. I'm going to do what the volatility is for that specific time period. You should never lose money, though. That's really important on a winning trade. So once it's working in your favor, what I like to try and do is potentially move the stop loss up to my entry level, so that if it does move back down, but obviously give it a little bit of distance, a bit of breathing room, because you don't want to be stopped out on a slight pullback if you're long, or a slight retrace high if you're short. But yeah, you never want to lose on a winning trade. So now that we finished with position size, I'm going to move on to correlation and interconnectedness of assets. So asset correlation, for those that don't know, is a measure of how different assets move relative to one another. So when assets move in the same direction at the same time, they're considered to be positively correlated. When one asset tends to move up, when the other goes down, the two assets are considered to be negatively correlated. It would be remiss of me to have this sort of discussion without speaking about the key role of the dollar. That's why getting your dollar direction and call right is actually so important, because it just affects so many other asset classes. So due to many different assets being priced in dollars, a strengthening or weakening of the US dollar can impact their price changes. For example, typically a stronger dollar hurts oil and gold, as investors with other currencies can now buy less of oil and gold priced in dollars because their currencies have weakened against the dollar. So these assets share a negative correlation. And then we've got, some equity markets derive a substantial amount of their earnings from offshore sales, and will therefore be hurt by a stronger currency. So for the S&P, you'd obviously be looking at the dollar, and vice versa. A weaker dollar would help boost those earnings when translated back into dollars. So here I've just actually chucked up a chart. So what we have on the right axis is the dollar index, DXY, and I've inverted the scale. So it's actually going from lower to higher. It's increasing downwards, and then on gold on the other left y-axis, it's actually increasing. So it's just a normal scale. But you can see, so as the dollar starts to increase in value and get stronger, gold, the orange line, begins to decrease. And as the dollar starts to pull back slightly, gold starts to increase in value again. So yeah, this is, I've put this chart together because I wanted to illustrate that close interconnectedness and correlation. And gold's also got a strong correlation with the real yield. And what the real yield is just your nominal yield. So take your US 10-year yield, it's trading at about 140 at the moment, 1.4%. And you minus inflation from that, and that gives you the real yield. Okay. So pairs trading is something which relies a lot on correlation. I don't want to spend too long on this because it could require an entire presentation on its own, but I just thought I'd run through it quickly for those that could be interested to maybe do a bit more research on their own. So it's used by sophisticated investors like hedge funds, and it's based on the historical correlation between two assets. So when two assets have a strong correlation and a dislocation occurs, there is an opportunity for reversion back to that normal relationship. So there's two legs to the trade. You'd short the underperforming asset and you'd long the outperforming asset. So you're essentially playing the spread. It's classified as market neutral neutral because you don't really care about the general market price direction. And both positions must be the same size in dollars. So some examples of potential pair trades that one could look at would be, companies that are in similar industries, so Pepsi and Coca-Cola, Twitter and Facebook, two oil giants, BP and Royal Dutch Shell, two banking giants, JP Morgan and Goldman Sachs, or you could look at closely correlated FX pairs like the Australian dollar, US dollar, New Zealand dollar, US dollar. You could create a price ratio, gold divided by silver, and you could overlay that with a Bollinger Band to see when the relationship is at extremes to be faded. I'm going to go through the Bollinger Band after this as we move into the indicators, and I'll give a little bit more color on what it is that indicator does and why it's useful and how you can use it. So moving on to what I think is the most important, exciting part of this presentation, we have the technical indicators for the medium and long term. So if you're going to be a slightly longer term trader and not in and out of positions, you need to use multiple time frame analysis. Now, what that involves is looking at the instrument you're trading over various time frames. So many successful traders, what they'll do is they'll perform a top-down analysis, which requires examining the longer time frames first, then zooming down to the smaller time frames. This technique provides a bird's eye view of the market. If you're going to be holding positions for slightly longer, it's obviously important to zoom out and get a bird's eye view. The longer term support and resistance are more important, more likely to hold than shorter term support and resistance. So what I'm meaning by that is if you're looking at support on a monthly chart as opposed to an hourly chart. Longer term perspective defines the overall trend, and shorter time frames can be used to achieve that optimal entry and exit positions. You want to try and get confirmation on the longer time frames, monthly and weekly, as well as on the shorter time frames, daily, 4 hour, hourly. Moving averages. Now, this for me is an absolute imperative part of your trading. You should really try to incorporate it. So it's one of the most diverse and useful trading tools available. It smooths out price movement and filters out volatility to try and give you a clearer picture of the trend. Shorter moving average is less smooth and will respond faster to price changes, whereas longer moving averages with sizable longer term price movements cause changes in trend direction. The two most popular types that are used by traders are the simple and exponential moving average. The simple moving average just weights all price data equally. So if you took a 20-day, it would just weight all previous 20 days price data equally while performing that calculation. Whereas the exponential moving average places more weight on recent price figures. So if it was a 21-day exponential moving average, which is one I like to use, it would weight, let's say, the most recent 5 days in that calculation more heavily. So it's like a weighted average essentially. So the EMA will be more reactive depending on where price moves. The time period you use comes purely down to what time frame you intend on trading. A shorter period moving average are better for shorter term trading, whilst longer period moving averages are best suited for more protracted, longer holding periods, i.e. your 50 and 200 days. Interestingly, the 50 and 200-day moving averages are closely monitored by institutional investors who are able to exert large market moves. So therefore, in my opinion, it's quite wise to keep an eye on these two moving averages, because if institutional players are looking at these with quite a keen eye and they can exert these large price moves, it gives you more profitable opportunities and more volatility to take advantage of. So some of the uses of moving averages. If the moving average is pointing upwards and the price candles are above the moving average, this indicates the price is trending up, and would be vice versa for a downtrend. So the price candles be below the moving average and the moving average would be pointing downwards. So to avoid fake triggers, you would use multiple moving averages. So if the faster, shorter moving average is still below the slower, longer moving average, then it's more likely that it's a price spike as opposed to a price reversal. You can use crossovers for entry and exits if the shorter term moving average, say a 21-day EMA, crosses above the longer term moving average, the 50-day SMA, and you want to go long. This could be a potential entry trigger. Or alternatively, if you're short, it could be a signal to begin thinking about exiting the trade. Be careful during sideways markets. Moving averages can produce whipsaws, and it's most effective in trending markets. One of the most famous crossovers is the 50-day SMA with a 200-day simple moving average. When the 50-day SMA crosses above the 200-day SMA, it's called a golden cross, and it's typically a bullish signal. So price would be moving higher, while a cross below the 200-day SMA would typically be bearish, called a death cross, and you'd be looking at potentially, if you were long, to exit the trade, or if you were wanting to go short, you'll be looking at entry positions. They can also be used as dynamic support and resistance, shorter term moving averages. I'll show when I go through the charts towards the end of this presentation how the price candles, the lows and the highs, tend to be capped by those moving averages, the shorter ones. And here I just want to indicate on a chart. So with gold back at the beginning of this year, we had a death cross where the light blue is the 50-day simple moving average cross below the dark blue 200-day simple moving average, and it precipitated a nice bearish downtrend move in price. And as I was saying just very recently now about how the highs of the candle are being capped by the 21-day exponential moving average on the daily chart here, and it's acting as like a dynamic resistance. So you could be shorting these positions as it moves back up to that moving average. So yeah, moving averages are very diverse and a very useful tool for traders to incorporate. Now momentum, the main three are moving average, convergence, divergence, stochastic, and relative strength index, the RSI. So I'm going to discuss the RSI in more detail because it's one I use particularly more. So obviously momentum indicators signal the speed and strength of the price move. And the default setting on most charting software is a 14 time period. So if you're using a daily chart, it'll be a 14-day time period. So now you can mess around and play and with these time periods, and a lower time period would obviously increase the sensitivity, while a higher time period will reduce the sensitivity. And what I mean by that is it would just move the indicator quicker to overbought and oversold, or be reached faster. So overboughts obviously are reading above 70, oversolds are reading below 30. Some use a move above 70 and then back below as a trigger to open a short position, and some would use a move below 30 oversold and back above that line as a trigger to open a long position. The RSI tends to fluctuate between 40 to 90 in an uptrending mark, with 40 to 50 acting as support. I'll show in an image from a screenshot from a chart on the next slide. And in a downtrend, it tends to fluctuate between 10 to 60, with 50 to 60 acting as overhead resistance. This is what I was meaning in the next slide. So I've circled with little green circles. The dotted line here is at 40.53. And essentially, it's showing this is the S&P 500 index. And as you see, the price moved back down. The RSI came and touched that support. And as I said, in an uptrending market, it tends to hold those levels. And you can see this beautiful uptrend in action. So that's another sort of tool you can use, as well as an uptrend line, moving averages, and support and resistance zones. So another very handy use for the RSI indicator is something called divergence. Now, what divergence is essentially, it's when the price action moves in the opposite direction to the RSI indicator. So if price is making higher highs, and the momentum indicator should too. If the momentum indicator is making lower highs, then you have divergence. It can be quite helpful in identifying potential trend reversals. Positive divergence would be when the price makes a lower low, but the RSI marks a higher low, indicating momentum of the downward move is waning, and therefore a trend change upwards could be on the cards, i.e. a buying opportunity. Negative divergence would be when the price makes a higher high, but the RSI makes a lower high. And that could indicate buying momentum is weakening, and a trend reversal lower could play out, i.e. a selling opportunity. I've just wanted to illustrate it here with the dollar index. So you've got negative divergence. The price has made a higher high, but the RSI is making a lower high, and the price changed direction and moved sharply lower. So that's what I was talking about. It can be a useful tool for indicating a trend reversal. Now, as I mentioned earlier, Bollinger Bands and Fibonacci levels will be what we'll finish off with for this presentation before I move to the charts. And if you have any questions, we'll answer those then. So Bollinger Bands, essentially what they do is it's a measure of volatility. You place two bands above and below the 20-day simple moving average, which is 2 standard deviations away from the simple moving average. Now, 2 standard deviations, for any of those that were good at statistics at school, it covers basically 95% of the data. So movements above that are quite rare and indicate maybe potentially extreme moves which can be faded. Now, you might be wondering, why is it the 20-day simple moving average? Well, the creator of the indicator, John Bollinger, found this to be the most effective time period. Now, widening of the bands indicates high volatility regime, while a narrowing of the bands indicates a low volatility regime. And as I was talking about earlier, they can be used to fade extreme moves on the expectation of some mean reversion back to that simple 20-day simple moving average as price touches or breaches the upper or lower bands. So if it breached the lower band, you'll be looking at going long, and if it breached the upper band, you'll be looking at going short. And I'll show with a chart in one of the next slides. Actually, no, I'll show it in my charts when I pull them up after the slide presentation. The last point, Fibonacci levels, they're used to identify potential supports and resistance levels during a price retracement. The logic behind them is that it will bounce off these levels and revert back to the original trend. So the key Fibonacci levels to keep an eye on are 23.6%, 38.2%, 50%, and 61.8%. 38.2% and 50%, I'd say, are the most important. You just have to pick a significant low and high price point called a swing low and swing high respectively on your charts to actually get it set up, and charting software will do the rest for you. You don't have to sit there manually calculating it. So when price is moving upwards and begins to retrace down, you'd want to be eyeing up buying opportunities at the Fibonacci support levels. When price is in a downtrend and retraces up, you'd want to be looking at potential shorts around the Fibonacci levels. A profit target for you could then be the previous swing low or high, depending if it's in an uptrend or downtrend. And you would look for further confirmation from maybe some reversal candles to provide that further confirmation for you for a move back in the direction of the original trend. So thank you. That is the end of the PowerPoint presentation. And from there, I'm going to be going on to my charts. So we'll be looking first at the dollar index. I'll just be running through basically how I kind of look at trades and price action and what comes into my formation. So what I've got here is the pink line is the 21-day exponential moving average, and the light blue line is the 50-day simple moving average, and the dark blue line is the 200-day moving average. I've got the RSI 14-day period there, and I've put the Fibonacci up here. This is a daily chart, just for anybody that was wondering. So what we can see here is the dollar's started to surge back up higher. And I would say that this is basically due to, the Federal Reserve having lit the policy normalization fuse at their previous meeting, where they were talking more openly about tapering. And we saw that hawkish shift in the dot plot for 2023, where we actually saw the FOMC members now seeing not one, but actually two 25 basis point rate hikes over 2023. So I think that sort of jolted the market into a little bit of action, and we saw the market pricing in some more aggressive interest rate expectations. Then technically, we've got a cross above the 21-day exponential moving average, crossed above the 50-day as well as the 200-day. And it looks as though if price continues high, we could get that famed golden cross. And as I was talking to you about, the 200-day simple moving average, really key support level. Big institutions look at this, and we can see the price candle, the lows went down and touched it and held that area very well. The 21-day exponential moving average is quite a nice dynamic resistance support tool. It acted as resistance back here in April throughout to May, and now it would likely act throughout July as dynamic support. I also put a 61-day, the Fibonacci 61.8% level. It's breached through that. I did it as if it was in a downtrend, and it breached through all the key levels, and it looks to be continuing up. It is acting as a little bit of support too. My only concern to the dollar bullish outlook here would be that there's a tiny bit of negative divergence, as I was talking about earlier on the slides. We've got price making higher highs, but the RSI is making lower highs here. But it is quite minor, so we'll have to just monitor that. It's not obviously foolproof. If it was foolproof, I'd be sat on a beach somewhere trading, and I'd just be using the RSI divergence. So you've got to use other tools for confirmation. Then the euro, obviously a key currency pair. Tiny bit of positive divergence here. Price is making lower lows, and the RSI is making higher lows. So we could see a bit of a retrace back up to that trend line, the 21-day exponential moving average. And it looks like there's a tiny bit of resistance there on the price candles just under the 120, 1.19711. And then going on to cable. Getting the technicals out the way here, the fundamentals, I would, for the euro, don't look that good because of their historically weaker inflation. Their central bank, the European Central Bank, is going to be a lot more hesitant to normalize policy. And as a result, that divergence between the Fed is going to open up quite widely, and that's going to drive that interest rate differential is going to drive, in my opinion, the euro US dollar lower. So you should be looking at potential short opportunities while looking at the euro US dollar. That's where my bias would lie. The pound I'm a bit more uncertain on because the dollar, obviously the Fed have started tightening slightly. Well, speaking about tightening, and the pound, I think a lot of people were potentially looking for a little bit more hawkishness at their July meeting, and we didn't see that. And if the Bank of England falls behind and isn't quite as tight as isn't quite as fast in normalizing policy as the Fed, then we could see cable actually start to come back down to this double bottom area here, this 1.366 support, where we had the double bottom pattern. Just below there's a 200-day moving average of 1.364. If it breaches through that, I'd be quite nervous. Again, tiny bit of divergence. Prices made lower lows, but the RSI is not confirming that, showing that selling momentum might be waning slightly. 21-day moving average, exponential moving average is capping those gains there. You can see the price highs getting capped and sellers are coming in. US dollar JPY, this is going to be a really big theme because as we see those US yields move higher, as potentially tapering starts to begin for QE and the economy starts to get even stronger. The US 10-year yield is a massive driver of the US dollar JPY. There's a large correlation there. And what we can see technically here is, we've got this beautiful uptrending ascending channel supported dynamically by the 21-day exponential moving average. It broke through this horizontal resistance up here at 111. It's retraced slightly back now. It'll be key to watch what the RSI does at that 46 level to see if it holds that support, because as we see, every time price dipped in this channel, it came back and touched that support of the RSI at 46 and carried on its uptrend. If it breached that below it, you would need to also confirm that with a breach of the uptrend line here, and to maybe start thinking, hang on a second here, maybe it's changing. But for me, the bias is to the long side, just purely because I think from here, US 10-year yields are going to be moving in a northerly direction. And as a result, that will put upward pressure on this cross. The AUD US dollar, just thought I'd bring that out. It's broken out of this range here. It was in a range between 0.78 and 0.75. Surprisingly today, we got a slightly, I wouldn't describe it as hawkish, but it was not dovish, and as a result, maybe there was some positioning changes. It did strengthen quite a bit earlier on in the trading session, but now we've seen as it hit that 21-day exponential moving average, as well as the 200-day simple moving average and that range support, which is now acting as resistance. Sellers came in and hit it lower. An interesting cross to trade would be the Aussie dollar, New Zealand dollar, because New Zealand, Reserve Bank of New Zealand are now looking a lot more hawkish. Some are even pricing in an interest rate hike towards the end of this year, which would be a lot sooner than the Aussie dollar. And as a result, the Aussie dollar, New Zealand dollar would be heading lower. The Euro GBP, if I was to bet on pound strength, I'd be betting on it against the Euro. Again, I think there's going to be divergence between the central banks, although the BOE might not be as hawkish as Canada or Norway or New Zealand potentially. It is still more hawkish than the European Central Bank. And as a result, I would say that the bias to here would be a short the rallies approach. It was in this range. It did break out of it, and it seems to be just hanging on here for dear life. Very stagnant price action. If we zoom out a bit further, we can see that if it breaks that range, we could see a retest of in the beginning of 2020 at 0.83, and that would basically be where it's been trading post-Brexit referendum. It's been in this massive range between 0.89 and 0.83. So if it was to break that 0.83 post-Brexit referendum range, then wow, we could really see a strong move then. And you can see even on the RSI indicator, not only is price action trapped in this range, well, look at the RSI, it's trapped in this range between 52 and 41. You could use that as further confirmation to assist in your trading. Both moving averages are pointing downwards. The 21-day exponential moving average is crossed below the 50 days. So the momentum in the short term is to the downside.
We definitely need to mention oil, which has actually been hit quite hard today, but it's been in this beautiful uptrending channel. You know, OPEC, the meeting last week, we got no resolution. United Arab Emirates aren't too happy about the current deal, and they're sort of holding out. And obviously, that uncertainty is keeping oil supply, withholding oil supply from the market, and as a result, it's putting upward pressure on oil. So for me, my bias is towards the upside for oil in the short term. If we do see an agreement come out and there's a bigger than expected oil supply agreement, it could put a bit of pressure on oil. But I still think this is a instrument that's ripe for a buy the dips approach. And you could look to the 21-day exponential moving average as a potential trigger point to enter some fresh longs. We'd look for that RSI to stay above that 53 level there. I would say that my price target for oil over the medium term would be about 80, and then we'd have to see what the market conditions are from there to reassess new fresh price targets. I just wanted to show you here, this is the US 10-year Treasury yield in gold. Again, I've inverted the gold axis this time, so going downwards is an increase in gold price. And as we can see, as the real yield actually increased, so it went from more negative to less negative, gold actually weakened. And now we can see here the real yield's weakening again, it's going more negative, and gold starting to increase again, and increase in price. Now, the real yield for me, I'm a bit bearish on gold going forward, just to share my views with you. And the sole reason for that is because I think that, you know, the Fed, unless we get some cataclysmic coronavirus variant, Delta, Lambda, Epsilon, whatever Greek letter you want to use for it, I don't think policy is going to get any more dovish from here. So there's a floor under real yields at the moment now where they're going to normalize and tighten from here. The reason why we're seeing weakness currently, in my opinion, is inflation break-evens are increasing as a result of an increase in the oil price, and nominal yields in the US, as you can see on the right-hand side there, are actually at 1.397. They're down quite badly today, 2.25%. And if your inflation obviously increases and your nominal yields don't, then your real yields are going to fall because you're minusing an increasing number from a flat number. And that's how you get to a lower real yield. But I do genuinely think that real yields, despite this temporary move lower, there's a floor. And if real yields do sort of continue on their trend upwards and start to go maybe to, let's say, 0.5 back up here, then gold's going to be under some serious pressure. And it would be a good instrument to short. Now, I've pulled up gold's chart. It does look a bit busy. Don't get overwhelmed by that. We've got the 61.8 Fibonacci level here to see that price is, you know, still in an uptrend. It's held it there, and it's actually retraced all the way back up to the downtrend line in the upper trend line of the descending channel, and the 21-day exponential moving average is there. We've also got a tiny bit of resistance at 1.8, the round number. But now what I wanted to show, we also had a bit of divergence. I've actually put it there so you can see higher lows, lower lows on gold, and it's turned up a bit. But I think this is more of a fundamental move than a technical move when we've seen that lower real yield. So what I wanted to show is with these Bollinger Bands fading the extremes, as you can see, price shot up above the upper Bollinger Band, and it was right next to that upper trend line, the descending channel, and it would have been a good shorting opportunity to fade the extreme and see a move. An initial price target would have been back to that faint orange line, which is the 20-day simple moving average. And if you wanted to, you could actually probably have held it all the way back down to the lower Bollinger Band. So yeah, I just wanted to illustrate the Bollinger Band, how you would think about it, how you would incorporate in your trading. And then lastly, we've got Bitcoin, you know, really interesting, trapped in a range. You got Elon Musk tweeting, who causes plenty of volatility for this asset class. The RSI at 48 capping, price moves upwards. We've got the 21-day exponential moving average also capping it. A bit of horizontal resistance at 35.78K. And we've got the 50-day simple moving average also capping gains there. So that's interesting. It's like in a new little mini range between 35.78k and the major range support at about 31k. So we'll have to see what happens there. I'm going to now go to questions to the floor. So if you guys have any questions, please send them through, and I'll try my best to answer them. And I will be sending through a nice Twitter list for you guys to get started on the app to follow after this in the follow-up email. Hi guys, so I can see some hands are raised. Do you just want to drop a question in the little box there, and then I can answer it to everybody if anybody does have any questions. If I don't see any questions being asked after about 5 minutes, I will end the presentation and assume that people are finished. So you can access the recording. We're going to be sending a link in a follow-up email once it's been uploaded to our YouTube channel, and you'll be able to go back over it there, look at the slides, look at the analysis I've performed on the charts right now, and yeah, you'll be getting that soon, so don't worry about that. Yes, I'll explain the last step again. So you will be receiving an email which will have a link in the email which you can click on, and it will take you through to the recording of this webinar today, and it will be on our YouTube channel where you'll be able to rewatch it. So to get started in your trading, you just need to open up a demo account with us, and the support team will take you through that other layer. And you can experiment with the demo account, as I mentioned earlier in the presentation, and before you start with real money. So the basics of support and resistance, you can go back over on the slides and you can basically look at it, but just to give you a brief overview. So what support is? Support is basically where price comes back, and it's like a price level whereby it can't break through, and it tests it multiple times. So you see that buyers keep coming in at that level, and that gives you confidence to be more confident in buying and initiating long positions. Whereas resistance would be where price moves up and it can't get past it, it gets stuck up there, where sellers come in and push price lower. So that would be a place where you would be more confident in potentially price holding, and you could put a stop loss above it, or you could look to short. Al-Haji, we'll think about how we can get around that for you, and try and see if there's another form that we can put it in for you if you don't. You don't need to have a YouTube channel. You just need to be able to access YouTube, which is pretty easy to access on any internet. As long as you have an internet, you can access it. So it shouldn't be a problem, but we'll sort it out. We'll help you there. Okay, everybody, if that's it, I'll leave it for another. I'll leave it for another. I'll turn it off. I'll end the webinar presentation at 2:50 UK time. Okay, we've got another question through from Dylan. So Dylan, you can go back over this and you'll see the slides about where you can get different news influences certain markets and where to get that fundamental news from Twitter, from reading our research, and you'll become, as you start to read, you'll start to become more familiar with with how analysts like myself and my head of research view markets, what we factor in when we're performing analysis, and it's just reading
literally that's it, mate. Just the more time you read, messing around, honing your strategy. Google's obviously a great source. YouTube, if there's a specific indicator you want to look at. We've got educational content on our website, and yeah, I hope that answers your question. The Ichimoku system, we'll probably discuss that in another presentation potentially. It's not something that I personally use in my trading. I just use standard price candles, Al-Haji. So yeah. I just wanted to comment just something I noticed with medium-term trading. Obviously, you know, you've got to be more. You got to look at longer time frame charts, and you've got to look at longer moving averages, which I spoke about earlier. And you can use something like a trailing stop, so you can keep yourself in the position without having to monitor it every day, and it just basically would exit the position for you if it moved against you at a predetermined level. All right, everybody, if that's all the questions, I'm going to end the webinar now. I hope you've found it valuable and useful. And yeah, when we get the link, you'll be able to rewatch it again. And I hope it gets you started on your trading journey. And our support team will be sending out that Twitter list and a follow-up email to your accounts with the link, as well as our link to our Telegram channel, which is very useful. No problem. I'm going to type the website now. And you just go under the market analysis tab to read our analysis. Okay, perfect. All right, everybody, thank you very much. The webinar will now be ending. Enjoy the rest of your day.